I'm with me. I just.
If I'm at a church, and if I'm here with the pastor, okay,
Do we need, give me the word.
give me word. I'm here to get mine.
Okay.
Give me the word. Well, thank you, Ms. Sonia, for coming.
Oh, you're quite welcome.
Folks. Yeah, I'm good. I'm like it. Yeah. Yeah. So we're gonna have a very intimate session today, which is fine by me.
Sometimes those are the best ones.
Okay.
Right. So we're gonna do our homeowners workshop. First off, I'm James Scott.
Well, hello, nice to meet you, Mr. Scott.
Thank you. A little bit about me, retired Navy. So I joined a few years ago, 1992. So I did 23 years. How am I in real estate? What happened? I bought my first house in 2000. And I still can't tell you who that real estate agent lady was. I just know it was a lady.
Okay.
So I think that's a problem. So for those of you who are gonna watch this, if you don't know or remember who your agent was, it's probably because they weren't that good an agent. It's pretty significant when you buy your first home. So you probably should remember who helped you do that. So that piqued my interest in real estate. Fast forward, I ended up being a Navy recruiter. Sort of similar is that you don't get a reward from recruiting until the person comes back and say, hey, you changed my life, you helped me. And when I started feeling good about myself, I'm like, man, you did something worthwhile. So at the same time, got my real estate license, was able to help somebody purchase a home, and there was that same response. Hey, thank you. You helped made a significant purchase in my life. Thank you. So long story short, as I continued on, I kept my license active. When I retired in 2013, I just stayed into real estate. That's what I do. So I enjoy it. This is my passion. This is what I do. 24/7 is not a side hustle. It's not a get rich quick. HGTV ain't where it's at. So that's TV. So this is what I do 24/7. So I enjoy helping people. This is why I'm doing what I'm doing. So that's me. Today, we're going to go over a little bit, actually the whole buying process, but we're going to focus with Mr. Walter Anderson. You introduce yourself.
Good morning. I'm Walter Anderson. Just a little bit about myself. I guess by education, I'm a hotel restaurant management major. Came up in the hospitality industry. Made a transition to insurance. I still own a insurance agency, but now I'm specifically devoted my life to credit restoration and financial literacy. My entire life has been about service to others. Much like James too, there's a feeling that you get when you have genuinely helped someone. Okay, if you've ever been helped in your life, you know how it feels to get help from someone who didn't necessarily have to give it to you. Right. There was no incentive to do it, and that's what I'm doing now. I believe that there is a revolution going on right now. It is an economic revolution, and I'm leading it with financial literacy. So I'm happy to be a part of what James is putting together here, helping people to achieve the dream of home buyership, but also to help the wave of Americans take back over the country through ownership.
Thank you.
Thank you. Nice to thank you again.
Appreciate that. All right, so we're gonna get started. I don't know if y'all saw my last little video where my time was wasted, so I don't waste other people's time. So let's get going. All right, so this is how we're gonna break it down. Basically, we're gonna figure out. Are you ready to buy? What to do? Then we'll talk about the lenders and loans. Then we're going to actually go back to Walter about credit. And then we'll get through the whole process of purchasing a home. So hopefully you get something out of it. And let's get rocking and rolling. So the question is, are you ready to buy? Think about buying a home is not like when you go buy a car. How long does that take? You buy a car.
My car now.
Oh, that's pretty fast. They want to haggle with me all day.
Oh, about this 6-7 hours.
Yeah, well, yeah.
Because you gotta include the
Then you gotta go
the
get-
conversation, the financial part of it, everything.
Go grab some lunch. Or they try to take you home.
Yes.
But no. So long story short, we need to have a plan. So number one, let's think about, are we even ready to buy? Renting versus buying. So on the renting side, for some people, renting is more ideal, and that's fine. But generally speaking, it's much better to buy than to rent. Why? Because you're getting that equity. That's gonna be your money.
That's right.
You're not getting any of that rent money back, but that landlord is definitely using it for something, probably paying off the house or place you're staying in.
Sometimes it increases too.
Absolutely. Most of the time it is. They call it, I just went blank. Sometimes it happens when you got gray hair. But cost of living expenses, gonna raise the rent. But if you're a renter, you prefer fixed expenses, you got limited cash flow, and you move a lot. So you might need to continue renting if that's you. For the rest of us, for buying, you're gonna have a cash reserve. That equity, and we'll talk about that later. What is equity? You got stability. You know where you're gonna be at. This is your house. You're not moving. Tax benefit. That's a big one. So all of the taxes that you pay, your property taxes, the interest on your mortgage, all that stuff comes off of the taxes. So that helps out. And with our current president, I won't comment. Anyway, and then equity. All right. So those are the benefits. Then you gotta get into what type of home do you want to buy. Resale, that means the house is already there. Somebody's lived there, and it's called a resale, not a used home. Don't use that term, that's derogatory. Or a new construction. Now, it's weird because people think, I'm buying a new home, I don't need a real estate agent. Where'd you get that idea from? The process is still something that you don't understand. And that salesperson that you're talking to in the office works for the builder, not for you. So I got a good buddy of mine that's pretty frugal. I won't call any names. But they think, oh, I don't have an agent, so you gonna give me that commission, right? That's not how it works. So, real quick, when builders build homes, when they buy the land, the developer buys the land, then he sells it to the builders. The builders buy the land from the developer, then they build their homes and make their money that way. When they first start all of this, they know they want agents like me and other agents to bring people to their properties. So they build in that commission for real estate agents. So you're not getting the benefit. You may think that, oh yeah, they gave me $5,000. Well, guess what? They were gonna take $15,000 off as you had an agent, but you won't get to know that information because they have to provide it to you. They have to provide that to me. I have to know all the deals. So that's what I work for you. It's like going to court without a lawyer.
So good.
Do you think that's a good idea? So stop going into these new construction places by yourself. Get representation. It's already covered. It's not costing you anything. Promise you. All right. Let's keep going. Location, location, location. All of these things are gonna play into, number one, the price of your home. So if you're in the hood, prices are lower. I'm sorry. It is what it is. So compare what you want in a $150,000 house to what you want in a $250,000 house. Obviously, there's going to be some significant differences. School district, your taxes are going to be higher. I'm sorry, that's just how it's going to go. Transit, we're in Houston. I drove, an hour and a half on Thursday. I never left the city limits. That's just Houston. So people that are moving here from out of state, I get those calls. Yeah, I moved here, I want to buy a house. You do. Where do you work at? Oh, I think it's over here. Where you gonna live at? Oh, I live in K. I don't live in K. You don't. We'll talk. So for those people, we have to have conversations about this. Urban, rural, Hockley, right up the street from here, is slowly become, actually not even slowly, it's already popping up. That was rural last year. Right. There was almost nothing out there. Now they got 3 or 4 subdivisions popping up there. So, urban, rural, I want some land. I don't know where that comes from. Everybody thinks land ownership is so great. I want some land. What you gonna do with that land? I don't know. I just want it. I want to be close to my neighbors. I get that, not being close to your neighbors. But just land invites a whole nother set of issues. We won't get to that. We won't got time. Alright, and ultimately, you want the best location for your lifestyle. Number one, this is when you're gonna start thinking about buying a home. What do you need? Need, N-E-E-D.
Spell it out.
I need, if I got 4 kids, I need at least 3-4 bedrooms. I want 6 bedrooms. You don't need 6 bedrooms. I want a game room. I don't need a game room. So let's think about our needs, then our wants, and then we'll get into the budget, and then we'll get to our perfect home. Alright, so let's get into the nitty-gritty. Budget. If you don't use one, you gotta start. I'm sorry. I don't care how long you haven't been doing it. This day and age, you have to use a budget. We're gonna get into credit later on, like I said, with wall budget. You have to have a budget. You gotta know what you're spending, where it's going, how much you have coming in, and how much you have going out. It's not gonna fix itself, and neither is your credit. Alright, so calculate your debt to income. Basically, what do you owe every month, and what is your income coming in? Generally, your mortgage approval will go up to 50% for housing. Generally, they like 48s, but I've seen 50. That's general. So think about that. So if you're paying whatever your rent is, figure out how much of that is a part of your income. What percentage? They got a lot of calculators you can use too. Alright, so I'm about to step down. I'm gonna let Walter come and talk about credit specifically. But if you're not monitoring it, you're behind. It's an ever evolving number. It never stays the same. From month to month, and probably day to day if you check it that much. But it lives and breathes on its own. So with that, I'm gonna turn it over to Walter to talk about specifically credit, how to work with it, and then we'll get back into the buying process and we'll get all the way through.
Thank you, James.
Thanks, sir.
Okay, I want to start just right now and saying if we can all agree on one thing, okay? Good credit is earned. It is not given. Would everybody agree with that?
Yes.
Is that a fair statement?
Yes.
Okay. The other part about that, because good credit is earned, there are several things that can be done to maintain and promote good credit. Boosting good credit. Just like with James, if you are not monitoring your credit and not understanding it, you are behind the game, okay? And it becomes vital that you understand that before you take the step to, for most of us, the purchase of our home is the largest asset purchase in our lifetime. I mean, that's huge for generally, unless we become multimillionaires and then we're developing hotels and things like that, but for most of us, that's the case. So if we just look on the screen like that, your debt and income to debt ratio, okay, is one of the first things that the mortgage lenders look at. And like what James said, that's where are you versus your expenses versus your income. Secondly, payment history. That's gonna drive that. Of the credit accounts that you have, revolving and credit accounts, how do you treat them? Are you on time? Are you using all of the limit that they gave you? You using half of it? Just by people here in the room, what is the general rule of thumb for the percentage of credit that you available credit that you should use? What do they tell you to stay under?
30%.
I would say 30, yeah.
Okay, that is what's been told. You know what actually makes the credit move positively? 7% usage. 7. Again, remember that these credit bureaus are for-profit corporations. So now you understand where that 30% myth might have come from.
Oh,
Okay, to keep everybody reporting things on there. Because again, if they make money, if you don't have A1 perfect credit, then what happens? You're not eligible for the best deal, right?
The one they advertise.
The one they advertise. So they'll get you into it, but it costs you what? A little more down, a little more interest, a higher percentage. Okay, so now we start to understand the relationship of good credit versus the cost of money, right? The better your credit is, the cheaper money costs. All right. Length of history, and I want to go with that. You notice I went in order of the importance of what goes into your score. 15% length of history. Stop closing your accounts. James, am I right or wrong? Stop closing your accounts. The older account that you have And the better you take care of it, the more it's gonna weigh good for your score. Don't close your accounts. Manage them better, okay? Manage them better. 7%. New credit accounts, okay? Inquiries, as James will tell you like that, can kill you, okay? It shows you're unstable if you're going and trying to constantly get, you should not have, how many inquiries should you have in a 12-month period, max?
I would say no more than 3.
2, very close, 2. It's actually 3 and 18 months. And if they're hard pulls, it better be something, a mortgage,
Right,
a car,
right.
okay? If it's big purchases, and usually something, we call them life events, okay? Lastly, the types of credit. Revolving credit accounts is what has the biggest impact on your credit, okay? How many people know that rent could be added to your credit? Okay, up to 2 years. Because by nature, when you sign a lease, like we were talking about, it's worth a certain amount of money.
Right.
Every month that you pay that, you're paying down the balance on that whole credit. It's a revolving credit account. It should be added to your credit. Okay, so these are the type of things that we go through to try to help out. Promote financial literacy. That's it. Oh, okay, right there. Gotcha.
Sorry, I got the little bit.
Okay. Look at the breakdown of scores, right? We say what's good score, what's a bad score. 850 is perfect credit, okay? I'll have to honestly admit, before I got involved in this industry, I didn't think you could have a credit score below 500. Exactly. And after my second divorce, I guess. But what we're looking at is 68 million Americans have a credit score lower than 599.
Shut the front.
Look at that. So you start looking at where the percentile, now this is what is a good score. These are percentiles of where people are, okay? But the actual numbers, okay, find us all in a position where we are hurting because we don't understand credit, all right? The biggest thing that we're adding now, that I'm adding to my clients and my portfolio, to my clients' portfolio, okay, is the understanding of revolving credit accounts and the use of them to boost their scores. Secured credit cards are a fantastic way of adding to your credit score, of showing positive, responsible credit usage, and showing financial maturity. Don't be afraid to start with that to move forward. Lastly, as we relate to the home buying experience and to get accepted for that, I guess it was about 1999, after the mortgage crisis had actually taken place, that analysts started going back and looking at what was in common with most of the foreclosures. And in almost 95% of the cases, these mortgages were approved with people's credit scores that had items under dispute. That no longer takes place, okay? You will not get approved for a mortgage now if you have items under dispute. So it becomes imperative that you clean up your credit and it stays clean through closing. James, am I yes or no?
Yeah.
Okay, so that's the one thing. So now, just because you're disputing an item and you receive that initial increase in credit, okay, that's not going to be honored like it used to in the past. And so what I'm getting people through is we're getting beyond the dispute phase and getting to the deletion stage where it's no longer there and it's not coming back. Did I hit on everything that I think that we were supposed to? Is there anything that I might have missed?
Nope.
Let me okay. James will talk about down payments.
All right. Thanks, sir. While we're talking about all this credit and all this stuff about credit, why? Because that's the first thing the mortgage company's gonna do. Once you apply, first thing they're gonna see is what's your credit score. Why? I gotta jump out of my slide real quick. Bear with me. This. I wanna show y'all just something really quick. If it's gonna cooperate. Alright. This is an estimate. So I just wanna show you one or two quick things, on this program. This is a estimate from a loan, home price of 200,000, conventional loan, down payment, actually let's turn this to FHA. Come on. That's fine. Anyway, the number's up there. There it is, FHA. FHA is a type of loan, we'll get to that. Government backed, but the down payment is 3.5%. So all I wanna do is just change this interest rate. So I want you to see 4.5%, that's about average. I'm gonna change it 1 percentage point. So look at, right now, what the payment is, $18.97. That's your principal interest, this is your whole payment, taxes, all of that. And this is your closing costs. Let's change this percentage to 5.5. You got it? Whoa, where'd it go? It's not cooperating.
Well, it changed it, cause it was 12,000 for the rent to close, now it went to 15.97.
Closing costs went up, but your payment, what is this thing acting?
I think it went up slightly. Cause it was 18 something
You
else.
definitely got, this definitely increased. Payment should definitely went up. Let's try it again. Oh, bear with me. Does not want to play today. Let's go back to 4. It should be at least $1,000. Okay. Alright, there we go. So let's start here with 4.5. The payment is at $16.98. One percentage point change. Today, computer. It's Saturday, so my computer is really acting goofy. There we go. So we went from $16.98 to 18. That's almost $200 a month increase by 1 percentage point on your mortgage. So that's why we keep talking about credit, because everything credit revolves gonna impact that percentage rate. So that's why we want it as low and our credit to be as high as possible, but we also want that interest rate to be as low as possible. So I wanted to show you guys that one, and I think I have one more instance. So let's do this. Let's do nope, I wanna do a rent versus buy. And let's use the same things. Let's say, what was it, 200,000? Oh, no, current rent. Let's say our rent right now is $1,500.
And are you gonna change that to an FHA loan versus?
Sure, let's do it.
Okay. And the home price is what,
200.
200,000, okay.
3.5%. And let's do some assumptions. So we'll leave the interest rate at 4.5. Insurance is pretty standard. Taxes around here generally about 3.1 at least. So let's be realistic. HOA, let's say it's probably $650
Annually?
annually.
Okay.
Alright, and we'll leave the rest the same. So let's look at this. Okay, what is this showing me? So it says in 2 years and 6 months, I'll break even if I bought my house or if I'm renting. What is that? Let's look at that. Right here. So this blue line is the purchase. And this yellow graph part is the rental. So at year 2 years and 6 months, I've broken even from my purchase. Because I had to pay down payment, I had to do closing costs, all of that stuff that I had to pay up front. In 2 years, I've paid myself back that money. Now let's move on. What happens with rent?
The rent increases.
It just keeps going up and you never get any of it back. Whereas this money here, now let's start looking at some details. Watch this. Let's look at equity. at 2.5 years, I now have $33,000 from my house. The money that I put down, everything that I've paid into it, I still have that money. It's now equity.
It's an investment.
It is an investment. Watch this in year 5. My equity is now $61,000 in 5 years. I'm still paying that rent amount at my rental. How much equity do I have? Nothing. Alright, so I just wanted to show that these are the benefits of home ownership. Now let's get back to the slideshow. Alright, so we're talking about, we actually mentioned FHA. You guys could actually see that on the computer screen. Mention of FHA and VA. So people get these ideas, you gotta put $20,000 down on the house. That's not true. Conventional is the most fluid type of loan, or has the most leeway. You can qualify for a conventional loan based on your credit score. That's the only difference. So if you qualify for a conventional loan, you can do the things like you see on HGTV, buy a beat up house, fix it up, and do all those things. Whereas FHA has specific requirements. It's a government-backed loan. But the down payment is only 3.5%. So there's benefits to having each type. And then the VA for only veterans, that's the only program where there's zero down. You will have to put a down payment on all types of home loans other than VA. Now how you pay for that is 2 different things. Lots of programs Texas has to help you pay for that. So no, you don't need $20,000 out of that house. $20,000 out. Right. You got that sitting in the bank. Alright, so Resbank is one of the mortgage companies that we have here. What'd you say?
I said, huh? You said I have this in the bank. But you know, I'll go ahead and claim that. Go ahead. All right. Supernatural.
Alright. So the type of mortgage loan, and I'm not a mortgage specialist, I just have to know part of it. But there's some terms that we do need to know. So up here we got the fixed rates, FHA, VA, conventional loans. Those are the type of loans. So you know what a PITI is?
Principal interest, something and something. I forgot.
Ah, okay, she's smart. Principal interest is
Time
correct.
and something else, I think.
Principal interest, and I don't have room, but
It's okay. Just give me
Interest.
abbreviate. I got it. I'm a teacher.
taxes
Taxes, okay. That's what it is.
and insurance.
Gotcha.
So this is your mortgage payment. Now, and especially in Texas, because they don't even allow you not to, what's called escrow. Pay money into a pot, and then the mortgage company pays all the taxes.
It's not allowed, is that just anymore?
Not to have an escrow.
But you want one.
You have, yes,
Okay.
they will make you get one.
Gotcha.
The only way you don't have to have one if you put 20% down.
Gotcha.
And like I said, most of us don't have $20,000 sitting around that we can just plop down with it.
Right.
So this is normally your payment. What about MI?
Mortgage insurance?
Oh, look, she's been studying. She's been to class. She's been to class. Mortgage insurance. Who's that for?
The homeowner.
Mm-mm.
Probably wants to put an insurance company.
Nope. So, what's the first word?
Oh, really? It's actually for the lender, isn't it?
The lender.
Because they want to protect.
The lender.
Yeah. Okay.
So, the mortgage company, you get a strike. You know what a private is. So the mortgage wants to protect themselves, the mortgage company. So if you don't put 20% down, you will have a mortgage insurance payment that is included into your PITI. Nothing, not a separate payment. It will all be billed. You will make one payment, but a portion of it will go to mortgage insurance, and that's for the mortgage company. Once you hit 20%, you can refinance and get that mortgage insurance dropped off. They will make sure they get their money. People really don't think. I'm not gonna tell this story. But people think that they can get money and not pay it back. One way or another, those folks are gonna get their money back.
Always.
They're gonna get it.
And they gonna want a little extra if they gotta keep working for it.
Yeah. Escrow. Oh, we kind of almost talked about this. Everybody know what escrow is?
Kinda like a home savings account in a sense, but not really.
Pretty much. So what the mortgage company will do is create an escrow account. They put that money aside, and it's an estimate. It's an estimate. That's why your mortgage can fluctuate. Normally your first 2 years, especially with new construction, because those taxes are done in arrears. So they don't know on new construction what those taxes will actually be. And I'm not gonna get too deep into taxes because that's